Hey guys, it's Nick, and there are new signs today of a slowing housing market. The housing market cannot go up forever if people cannot afford to buy houses, right? Well, with higher mortgage rates and the Fed on track to hike rates by another half a point next week, mortgage affordability is going down fast, and mortgage applications are now hitting a 22-year low. Now, you may not be aware of it unless you're shopping for a house, but when you see today's numbers compared to the last housing bubble, it looks pretty obvious. Let's take a look at what's going on. So, in the Zero Hedge article, mortgage applications crashed to 22-year low as monthly payments rocket higher. The Mortgage Bankers Association reported a 6.5% week over week drop in mortgage applications, and that's the fourth straight weekly drop to its lowest since 2000. So, this is based on an index, and this index hasn't been this low since all the way back here 22 years ago. And as for actual purchase applications, this is the lowest level outside of the COVID lockdown since 2016. So this just goes to show that prices can't go up forever. At some point, they become unaffordable to most households. And so this is really interesting. The median household income only covered 17.5% of the median new home sale price in March 22, the lowest on record. So that means that the median new house is more than 5 times the median household income for most Americans. And that is lower than the housing bubble in 2008. And what's really interesting is look back in 1971, the median household income covered about 37% of the median new house. So it's crazy to see how far we have fallen, because back in 1971, most households were probably the majority were one person working in the house. The man goes to work, the woman stays home, and they still had enough money to buy a brand new house that only cost about 2.5 to 3 times their yearly salary. Now, where are we? We're all the way down here where there are most likely 2 people working in a household, and it takes more than 5 times their combined yearly income to buy a new house. And so as house prices have gone up in the last few years, and now mortgage rates are going up, that means that the mortgage payment for a median new home as a percentage of median household income is going up a lot. It is now 33.8% of the median household income you have to pay for the median new home. That compares to just 24.5% right around the shutdowns. Now, that's not as high as it was during the housing bubble, which it got as high as 41.3%. But if interest rates go higher like they need to, and the Fed raises by half a point next week, this number is going to go up as well. So pretty soon it may be catching up to this 41.3%. And so not only can Americans not afford the price of houses, but they can't afford the price of a lot of things. And so they're putting it on their credit cards. And these are record levels of total consumer credit for the last 2 months here. And this is non-revolving credit like car loans and student loans, also hitting highs. And you heard all the stories that everybody was staying home during the pandemic shutdown and they weren't spending much. In fact, they were paying down their credit card debt. Total revolving credit dipped down below 1 trillion, about 970 billion, something like that. Right now, it is not only up to its old highs, but it has now surpassed it. So over $1.1 trillion. And student loans and car loans are also at all-time highs. But there is one thing at an all-time low, and that's the personal savings rate. And so whatever savings rate people had temporarily during the pandemic and all the stimulus checks and all of that, they promptly spent it, and now they're spending it on the price of higher food costs, higher energy costs, higher housing costs. And so they are tapped out, and their savings rate is now as low as it was back in 2008. And so not only are people maxed out on their credit cards and can't afford houses and the higher price in cars and fuel and food, but shipping stocks are now crashing after FreightWaves' latest recession alert. And this shouldn't be a big surprise because recently Target and Walmart and the big retailers said that they bought too much inventory because they were worried about supply shortages. So they overbought too much. They're not selling it. They're going to have a big sale. And because of that, they're not reordering a lot. They're reordering a lot less. And they're reordering a lot less because they know consumers don't have the money to buy all the stuff that they thought they did. So add to all that bad news, you got the CPI report coming out on Friday to see how bad inflation is for the month of May, and that's going to influence the Fed meeting next week, which they are already expected to raise interest rates by another half point, which will put a bigger damper on the housing market and the already squeezed consumers. So if that's not enough to convince you that we are heading for a recession, add inflation in energy and food, along with the Fed tapering their bond buying that was supporting the stock market all these years, and it looks like it will be tough times ahead. Hope you liked this video, and I'll see you in the next one. Thanks for watching, guys.